ExamPrep.School. Montana Surety Insurance Exam, exam code InsMT-Sure81 or OPMT-Sure81. There are 6 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Bail bonds, fidelity and surety contracts, purpose and type of fidelity bonds, purpose and type of surety bonds. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which of the following best distinguishes a fidelity bond from a surety bond? A. A fidelity bond guarantees performance of an obligation by a third party to an obligé, while a surety bond indemnifies an insured against employee theft. B. A fidelity bond indemnifies the insured for financial loss due to an employee's dishonest acts, while a surety bond guarantees a principal's performance to an obligé. C. A fidelity bond compensates an obligé when a principal defaults, while a surety bond covers losses from internal fraud. D. A fidelity bond is a contractual guarantee to an obligé, whereas a surety bond reimburses an employer for employee misconduct. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The correct answer is that a fidelity bond indemnifies the insured for losses caused by employee dishonesty, whereas a surety bond guarantees a principal's performance to an obligé because fidelity bonds focus on internal dishonesty exposures, and surety bonds involve a three-party guarantee of contractual obligations. Reason A is not correct. This is incorrect because fidelity bonds protect against employee dishonesty rather than guaranteeing third-party performance. Reason C is not correct. This is incorrect because fidelity bonds protect the insured, not directly compensate an obligé for principal default. Reason D is not correct. This is incorrect because surety bonds guarantee performance, not merely reimburse for employee misconduct. Question 2. In a surety bond arrangement, which party is referred to as the principal? A. The party to whom the performance guarantee is made and who benefits from the bond. B. The party that provides the guarantee on behalf of another to the obligé. C. The party whose performance or obligations are guaranteed by the surety. D. The party requiring the guarantee to ensure contractual compliance. The correct answer is C. The correct answer is that the principal is the party whose performance or obligations are guaranteed by the surety, because in a surety bond, the surety agrees to ensure that the principal fulfills its contractual duties to the obligé. Reason A is not correct. This is incorrect because that describes the obligé, who benefits from the guarantee rather than being guaranteed. Reason B is not correct. This is incorrect because that describes the surety which provides the guarantee. Reason D is not correct. This is incorrect because that describes the obligé's role in requiring the bond, not the principal. Question 3. A city hires Apex Builders to replace the dome on its historic courthouse and requires a performance bond guaranteeing work meets the contract specifications. If Apex Builders fails to complete the replacement properly, which party is the obligé under the bond, and what primary interest is protected? A. The city, its interest in having the courthouse dome completed according to contract specifications. B. Apex Builders, its interest in being reimbursed for work performed. C. The surety company, its interest in preventing financial loss. D. The subcontractor, its interest in timely payment for materials. The correct answer is A. The correct answer is that the city is the obligé and the bond protects its interest in the project's proper completion per the contract. Performance bonds ensure the owner, obligé, is made whole if the contractor, principal, defaults on its obligations. Reason B is not correct. This misidentifies the contractor as the obligé and focuses on reimbursement rather than protecting the project owner's completion interest. Reason C is not correct. This describes the surety's viewpoint and general financial interest, not the obligé's protected interest. Reason D is not correct. This incorrectly names the subcontractor as obligé and confuses payment interest with performance guarantees. Question 4. When underwriting a principal's credit history for a surety bond, underwriters most commonly examine which of the following sources? A. Credit default swap pricing metrics. B. Trade accounts and public record filings. C. Property appraisals of real estate holdings. D. Collateral valuation schedules. The correct answer is B. Trade accounts and public record filings provide direct evidence of payment performance and prior delinquencies, making them the primary sources for evaluating credit history and surety underwriting. Reason A is not correct. Credit default swap pricing is a market-based risk measure, not a primary credit history source for surety underwriting. Reason C is not correct. Property appraisals reflect collateral value rather than payment behavior or credit performance. Reason D is not correct. Collateral valuation schedules detail asset values and security, not the principal's history of obligations. Question 5. A surety underwriter is evaluating an application for a performance bond from Beacon Electrical. Beacon has completed 3 bonded power plant wiring projects over the past 5 years and had 2 minor repair claims resolved without any payment from the surety. How should the underwriter treat Beacon's experience with similar obligations in determining the bond premium? A. Apply a modest premium credit to the standard rate in recognition of proven performance. B. Increase the collateral requirement to offset potential unknown liabilities. C. Waive the indemnity agreement requirement given the clean loss record. D. Classify the risk as standard and maintain the full standard premium rate. The correct answer is A. The correct answer is that experience with similar bonded obligations allows the underwriter to justify a modest reduction to the standard premium rate, reflecting lower perceived risk while still enforcing standard indemnity and collateral provisions. Reason B is not correct. Collateral requirements are adjusted based on financial strength and indemnity support, not directly on prior performance when loss experience is favorable. Reason C is not correct. Indemnity agreements remain mandatory regardless of past performance to protect against future claims. Reason D is not correct. Maintaining the full standard rate ignores the favorable loss history and proven performance that warrant a rate credit. Question 6. In the typical surety claim investigation process, after receiving a notice of principal default, which action is performed first by the surety? A. Conduct a site inspection to assess the default. B. Interview the principal regarding the default. C. Request a supporting documentation from the obligé. D. Review the bond terms to confirm coverage obligations. The correct answer is D. Reviewing the bond terms to confirm coverage obligations is the initial step, as the surety must first verify that the claim falls within the bond's scope before pursuing inspections, documentation, or interviews. Reason A is not correct. Conducting a site inspection is typically undertaken after confirming that the bond covers the claim. Reason B is not correct. Interviewing the principal is a subsequent action after the surety confirms coverage obligations. Reason C is not correct. Requesting documentation occurs only after the surety has verified that the bond terms apply. Question 7. After a contractor defaulted on a municipal construction project, the obligé submitted a bond claim. To evaluate potential liability, the surety is most likely to request which of the following documents from the obligé? A. Certified copy of the original bond agreement. B. Updated project completion schedule. C. Detailed proof of loss statement outlining unpaid labor and material costs. D. Contractor's professional liability insurance policy. The correct answer is C. The surety requires a proof of loss statement to establish the amount of claimed damages. The other documents do not quantify the obligate's financial loss under the bond. Reason A is not correct. A certified bond copy verifies coverage but does not quantify damages needed to process a claim. Reason B is not correct. A project schedule updates timelines but fails to document the obligate's actual financial loss. Reason D is not correct. Evidence of liability insurance is unrelated to the surety's requirement for proof of bond claim costs. Question 8. During a performance bond claim, the surety analyzes three main remedial options: finance the principal's completion, contract with a third party to finish the work, or pay the obligé monetary damages. If the principal has adequate technical ability but lacks sufficient cash flow to complete the project, which remedy is most appropriate? A. Settle by paying the obligé the full penal sum. B. Hire a new contractor to finish the remaining work. C. Provide funds to the principal to continue performance. D. Require the obligé to renegotiate the contract with the principal. The correct answer is C. When the principal's capability exists but cash flow is the barrier to completion, financing their performance allows the project to proceed under the original team and generally minimizes costs compared to other options. Reason A is not correct. Paying the full penal sum would terminate the principal's involvement rather than address the cash shortage delaying completion. Reason B is not correct. Engaging a new contractor is suited when the original principal cannot perform or lacks expertise, not when only cash flow is constrained. Reason D is not correct. Obligé renegotiation does not align with the surety's direct remedial options under a performance bond. Question 9. Midco Insurance issues a performance bond for a municipal construction project. Because the underwriter cannot always sign each bond promptly, the insurer grants its appointed agent a power of attorney on the bond form. What is the primary purpose of including this power of attorney clause on the surety bond form? A. Allow the principal to delegate its bond obligations directly to subcontractors. B. Authorize the appointed agent to execute and bind the surety on bond instruments on behalf of the insurer. C. Permit the surety to cancel the bond unilaterally without court or obligee consent. D. Serve as standalone evidence of the indemnity agreement between the principal and the surety. The correct answer is B. The correct answer is that the clause grants the appointed agent authority to execute bond instruments on the surety's behalf when the insurer's officers are unavailable, ensuring bonds are issued without delay. Without this provision, each bond signature would require direct sign-off by senior underwriters or company officers, which could impede timely performance. Reason A is not correct. Delegating bond obligations to subcontractors is unrelated to the agent's authority to bind the surety. Bond obligations remain with the principal and surety. Reason C is not correct. A power of attorney does not confer cancellation rights. Bond cancellation follows specific contractual and statutory procedures, not agent authority. Reason D is not correct. The indemnity agreement is a separate contract and not established by a power of attorney clause on the bond form. Question 10. Which statement best describes the primary purpose of a public official surety bond? A. Indemnify the public treasury for losses caused by a public official's willful misconduct or negligence. B. Guarantee the performance of statutory duties by a public official to their employing agency. C. Provide liability coverage for personal legal expenses of a public official. D. Ensure repayment of salary advances provided to a public official during term. The correct answer is A. The correct answer is indemnifying the public treasury, because a public official surety bond exists to protect public interests by reimbursing losses that result from official misconduct or neglect. Reason B is not correct. This option misstates the surety bond as a performance guarantee rather than a mechanism for financial reimbursement to the public. Reason C is not correct. This describes liability insurance for personal expenses, which is not the function of a public official surety bond. Reason D is not correct. This refers to repayment of advances, which falls outside the indemnification scope of a public official bond. Question 11. During an annual audit, it is discovered that a county clerk inadvertently combined $15,000 of personal savings with $150,000 in municipal escrow funds, and later separate records could not be fully reconciled. Under the faithful performance public official bond covering the clerk's term, which loss would the surety indemnify? A. The shortfall revealed after the clerk left office when escrow records were audited. B. Money taken through intentional embezzlement before the clerk's official appointment. C. The $15,000 commingled with public funds during the clerk's bond period due to a record-keeping error. D. Interest lost because funds were not invested in authorized municipal securities during the term. The correct answer is C. The correct answer is that the surety covers the $15,000 commingled during the clerk's term. A public official bond guarantees faithful performance of office duties and indemnifies losses from misapplication or commingling of public funds while the bond is in force. Losses occurring before or after the bonded period and consequential interest or investment performance losses are excluded. Reason A is not correct. This loss occurred after the bond period ended, so it is not covered by the bond. Reason B is not correct. Acts committed before the bond took effect are excluded from coverage under the bond. Reason D is not correct. A faithful performance bond does not cover lost investment returns or interest on public funds. Question 12. In appellate proceedings, what is the primary purpose of a judicial bond posted by an appellant? A. To secure payment of the appellant's attorney fees incurred in the trial court. B. To guarantee that the appellant will comply with the performance terms of the original judgment. C. To indemnify the appellee against all court costs and any damages if the appeal is unsuccessful. D. To ensure the faithful execution of duties by a court-appointed fiduciary during appeal. The correct answer is C. The correct answer is to indemnify the appellee for court costs and damages when an appeal fails, which is the specific purpose of a judicial bond in appellate proceedings. Reason A is not correct. Attorney fees are not the subject of a judicial bond. The bond covers court costs and damages to the appellee. Reason B is not correct. This describes performance of the original judgment rather than indemnification against costs and damages arising from the appeal. Reason D is not correct. Fiduciary duties relate to fiduciary bonds, not judicial bonds in appellate procedures. Question 13. When a court requires a newly appointed guardian or trustee to post a fiduciary bond before taking control of an estate, what is the primary purpose of that bond? A. To ensure payment of court administrative fees. B. To protect beneficiaries against losses from fiduciary dishonesty or negligence. C. To confirm that the fiduciary meets professional qualification standards. D. To cover potential tax obligations of the estate. The correct answer is B. The correct answer is that the bond protects beneficiaries by indemnifying them against losses caused by a fiduciary's dishonest or negligent actions, which is the fundamental purpose of a fiduciary bond for guardians, trustees, or executors. Reason A is not correct. The bond does not relate to court fee payments, which are handled separately by filing fees. Reason C is not correct. Qualification of a fiduciary is verified through court vetting, not by a financial bond. Reason D is not correct. Estate tax obligations are addressed through tax filings, not by a fiduciary bond. Question 14. A municipality engaged Stellar Construction to build a public library and required a performance bond from Apex Surety Company for contractually specified completion. After the contractor fell 30% behind schedule with no progress toward final inspection approvals, the municipality invoked the bond. Under the terms of the performance bond, What is the surety's primary obligation to the municipality? A. Arrange for completion of the project or complete it itself within the penal sum. B. Pay the municipality an amount equal to the full penal sum of the bond upon breach. C. Advance funds to the contractor to purchase additional labor and materials. D. Indemnify the contractor for any assessed liquidated damages. The correct answer is A. The correct answer ensures that performance bonds obligate the surety to see the contract completed, either by providing the means or finishing the work, rather than simply paying out the penal sum or indemnifying the contractor. Reason B is not correct. This choice describes a penalty bond payout, but performance bonds require actual completion or arrangement for completion, not automatic payment of the penal sum. Reason C is not correct. This distractor wrongly treats the bond as a financing mechanism, but surety's duty is to secure performance rather than fund the contractor. Reason D is not correct. Liquidated damages pay the obligé for delays, but performance bonds focus on completion rather than indemnifying the contractor. Question 15. Westlake City requires all electrical contractors to obtain a license bond. Electric Pro LLC secured a $75,000 license bond from Meridian Surety and performed several installations. A homeowner later claimed damage after improper wiring caused a fire. Under the license bond, what obligation does the surety primarily have regarding the homeowner's claim? A. Reimburse the licensing board for fees lost due to license suspension. B. Ensure that the contractor performs all future work in compliance with the electrical code. C. Investigate and impose disciplinary sanctions on the contractor for professional misconduct. D. Pay for the homeowner's losses up to the penal limit after proof of liability. The correct answer is D. The correct answer reflects that license bonds protect the public by compensating claimants for financial harm caused by the licensee up to the bond's penal sum once liability is established. Reason A is not correct. License bond funds address public claims, not reimburse licensing authority fee shortfalls. Reason B is not correct. This distractor confuses the bond with a compliance guarantee. License bonds secure compensation for losses, not ongoing compliance. Reason C is not correct. Disciplinary authority lies with the licensing board, not the surety under a license bond. Question 16. Which of the following best describes the primary purpose of an individual fidelity bond covering a named employee? A. Guarantee that the named employee will strictly adhere to contractual performance obligations. B. Provide coverage for third-party bodily injury claims resulting from the named employee's negligence. C. Compensate the employer for losses due to acts of fraud, theft, or dishonesty committed by the specified employee. D. Secure the employer's financial responsibility in fulfilling state-mandated licensing requirements. The correct answer is C. An individual fidelity bond is specifically designed to indemnify the employer for direct financial losses arising from fraudulent, dishonest, or theft-related acts committed by the listed employee, protecting the employer's assets against employee misconduct. Reason A is not correct. This describes a performance bond guaranteeing contractual duties rather than indemnifying the employer against employee dishonesty. Reason B is not correct. This refers to liability insurance for third-party injuries caused by negligence, not fidelity coverage for employee fraud. Reason D is not correct. This pertains to a licensing compliance bond ensuring regulatory obligations, not compensation for employee theft or fraud. Question 17. Which of the following most accurately describes the coverage mechanism of a blanket fidelity bond covering multiple employees? A. Provides coverage for dishonest acts by any covered employees up to a single aggregate limit. B. Provides separate per employee dishonesty limits without sharing an aggregate pool. C. Requires each employee to be individually scheduled with specific limits per person. D. Provides indemnification for employers against losses from physical damage or negligence caused by covered employees. The correct answer is A. This option is correct because a blanket fidelity bond automatically covers dishonesty losses arising from any number of covered employees without naming each individual, applying a single aggregate limit for all such losses. Reason B is not correct. This is incorrect because blanket bonds pool all employee dishonesty losses under one aggregate limit, rather than assign separate limits to each employee. Reason C is not correct. This is incorrect because blanket bonds do not require individual scheduling or per-person limits. They cover multiple employees automatically. Reason D is not correct. This is incorrect because fidelity bonds cover losses from dishonest or fraudulent acts, not losses from negligence or physical damage. Question 18. A regional bank discovers that a senior teller has been embezzling funds by forging customer signatures on withdrawal slips. The bank holds a Banker's Form 24 fidelity bond. Which of the following best describes the protection provided by this bond? A. Coverage for losses arising from computer breakdowns or system errors without employee dishonesty. B. Indemnification of customers for lost uninsured deposits in the event of bank insolvency. C. Claim presentation depends on the principal's consent. Bond forfeiture action proceeds without any party's approval. D. Reimbursement for the bank's direct losses from employee-perpetrated fraudulent or dishonest acts. The correct answer is D. This option is correct because Banker's Form 24 is specifically designed to indemnify a financial institution for direct loss of money, securities, or other property resulting from fraudulent or dishonest acts committed by its employees, rather than covering deposit insurance, legal defense, or pure system failures. Reason A is not correct. This option focuses on system errors without dishonesty, whereas the fidelity bond only covers losses from employee-perpetrated dishonest acts. Reason B is not correct. This choice incorrectly implies coverage for customer deposit losses, which are addressed by deposit insurance rather than a fidelity bond. Reason C is not correct. This distractor mischaracterizes the bond as providing legal defense funding, which is not included under fidelity bond terms. Question 19. After arraignment, a licensed surety posts a $10,000 bail bond to secure a defendant's release. When the defendant fails to appear at trial, which obligation of the surety was the bail bond primarily intended to guarantee? A. Defendant's appearance at all required court proceedings. B. Payment of any resulting fines and court fees. C. Compensation to victims for damages. D. Coverage of legal defense costs. The correct answer is A. The correct answer is the guarantee of the defendant's appearance at court. Bail bonds are designed to secure attendance, not to pay fines, restitution, or legal fees. Reason B is not correct. Payment of fines and court fees is not an obligation of the bail surety, which focuses solely on ensuring appearance. Reason C is not correct. Compensation to victims is outside the scope of a bail bond, which secures the defendant's court attendance only. Reason D is not correct. Coverage of legal defense costs is not provided by a bail bond, as sureties are not responsible for attorney fees. Question 20. In a bail bond transaction, the surety bond fee most accurately refers to which of the following? A. The non-refundable docketing fee paid to the court clerk for filing the bail bond. B. The refundable security deposit held by the court and returned at case conclusion. C. The non-refundable premium paid to the surety for its guarantee of the defendant's court appearance. D. The escrow deposit provided by the indemnitor as collateral held by the surety until exoneration. The correct answer is C. The surety bond fee is the premium a defendant or indemnitor pays to the surety company in exchange for its promise to cover the bond and guarantee court appearance. It is non-refundable regardless of case outcome, compensating the surety for the risk undertaken. Reason A is not correct. Court docketing or filing fees are administrative charges imposed by the court clerk, not payments to the surety. Reason B is not correct. Refundable deposits held by the court are returned upon case resolution and are not payments to the surety for risk assumption. Reason D is not correct. Escrow deposits by indemnitors serve as collateral against losses and do not constitute the fee for providing the surety guarantee. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.